Fourth, I think the Chinese government has misread the political situation here in America, totally misread it. They want to wait Trump out and make a deal with more friendly Democratic administration. But that depends on who the Democrats nominate. Elizabeth Warren's in second place in a number of polls, tops in Iowa. And if you read her position papers, she's even tougher on the Chinese than Trump is. Final reason to be cautious, the technicals. Even after today's brutal breakdown, we still aren't actually oversold. The averages have been flying so high for so long, now we're just taking out a lot of levels of the downside, which means there's no real natural place to land. I'm waiting for the proprietary S&P oscillator that I paid for and I followed to hit -5. That's a classic sign that we've come down too far too fast. But we aren't there yet. In fact, we're really at -2.7. That's not good. So if we're waiting for all these shoes to drop, why even bother to try to pick stocks at all? Why am I still saying you should get involved and start buying tomorrow? Simple. Because bond yields, which everyone's saying, ooh, so scared, they've plummeted. Right now, the benchmark 10-year Treasury is giving you a 1.73% return. If you're an investor who wants income, and a lot of people do, dividend stocks are pretty much the only game in town. So there's a whole cohort of 3% yielders that's become a lot more attractive here. Stay tuned after the break for a list of my favorites. For now, all you need to know is that interest rates in the rest of the world are so low, you better believe ours can go lower. If only from pure panic they'll go lower. People flee into bonds as a safe haven. That puts downward pressure on those yields. Plus, here's a little reality check. Overall earnings have been quite good for all sorts of companies, both domestic and international. We just had a fabulous quarter from LivePerson and Afria, the pod company, and both are on tonight. You'll hear the stories. After the bell, we got a magnificent quarter from Kramer Fave Take-Two Interactive. That's Strauss-Zelnick. That stock deserves to be higher. Sure, the stocks with overseas exposure might have more downside, but the domestic names are buyable. And I think a lot of them are buyable right now. Again, on a downtick. Don't pay up if the opening's up, please. I'll find you. Don't forget, the president is a mercurial man. If the Dow Jones Industrial Average keeps plummeting, first he lashes out at Fed Chief Jay Powell's stewardship. I mean, that's an easy one. I hear Jay. Or he might leak some positive chatter about the trade negotiations with China. He just needs to tantalize enough of Wall Street to make the panic stop. That could happen tomorrow if we were open down a lot. I mean, why not? I mean, what does he have to lose? Meanwhile, tons of stocks are down dramatically. Many are already down 10% from their highs. That's usually where I start to like to buy. Emphasis on the word start. You want to buy your shares gradually, in stages, so you can back up the truck if the market keeps rolling over. Not yet. Remember, the United States is a service-oriented economy, not a big exporter. So there's plenty of domestic stuff that works here. Of course, everything is obscured by the collapse of FAANG plus Microsoft in today's trading. But that's what panic looks like. Bottom line, I have to tell you again, nobody ever made a dime panicking. Take a deep breath. Keep your head. Remember that stocks get cheaper as they go lower if there are quality companies behind them. If you slowly buy the stocks of companies with great fundamentals, you'll be in good shape when the smoke clears. Am I promising that? Well, pretty close to it.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.